Welcome to our discussion on 409A, Valuation versus Fair Market Value. This is crucial for founders before granting stock options. CountShare has completed over 65 Internal Revenue Service compliant valuations, ensuring you have the insights needed for informed decision-making. Fair market value, FMV, is defined by the Internal Revenue Service as the price a property would sell for on the open market, agreed upon by a willing buyer and seller. Fair market value is used in mergers and acquisitions, financial reporting, estate planning, and litigation. Importantly, fair market value does not provide Internal Revenue Service safe harbor, placing the burden of proof on the company during audits. A 409A valuation is an independent appraisal of a private company's common stock, essential under IRC Section 409A for granting stock options to United States tax resident employees. It applies only to common stock, not preferred shares or other instruments. A qualified appraisal provides a safe harbor, creating a rebuttable presumption of reasonableness with the Internal Revenue Service. Let's explore the core differences between 409A valuations and general fair market value, FMV. 409A focuses on Internal Revenue Service compliance for equity compensation, specifically common stock, and requires a qualified independent appraiser. It mandates discount for lack of marketability and minority interest discounts. In contrast, FMV applies broadly, with flexible appraisers and no safe harbor, often including control premiums. 409A. Valuations are often lower than investor valuations due to structural factors. Preferred stockholders have liquidation preferences, receiving priority in exits. Common stock, often a minority interest, has limited control rights. Additionally, a discount for lack of marketability, typically 25 to 35% for a 2-year holding period, further reduces common stock valuation. The Internal Revenue Service recognizes 3 valuation methods: independent appraisal, requiring a qualified appraiser; formula-based valuation, using book value or earnings multiples, mainly for non-institutional businesses; and illiquid startup valuation, for companies under 10 years old without public equity, not applicable if an initial public offering or change of control is imminent. 409. A. Valuations are crucial when granting options, required immediately. A funding close triggers a new 409A due to it being a material event. Annually, a safe harbor refresh is needed. For mergers and acquisitions and pre-initial public offering, deal fair market value is essential, with quarterly 409A updates as the initial public offering window nears, due to Securities and Exchange Commission scrutiny. Key distinctions between 409A and general fair market value include purpose, subject, safe harbor, appraiser requirements, and validity period. 409A is a compliance tool for common stock, requiring a qualified appraiser and offering Internal Revenue Service protection. It expires after 12 months or a material event. Fair market value is more flexible, applicable to any asset, and lacks procedural protection. A 409A valuation is distinct from fair market value, focusing on common stock under Internal Revenue Service rules. It requires independence and documentation for safe harbor. Funding round valuations aren't suitable for 409A due to differences in stock pricing and necessary discounts. Skipping a 409A can lead to severe tax penalties and complications during fundraising. CountShare's expert team offers Internal Revenue Service compliant 409A valuations with a 100% auditor acceptance rate. With over 10 years of experience, they deliver audit-ready reports in just 9 to 12 days at a fixed fee. Schedule a free consultation to ensure your 409A is compliant and defensible. We look forward to working with you. For any questions or collaboration opportunities, contact us via email or phone. Reach out to our teams at the provided addresses. We'd love to hear from you.